My next guest isn't buying the rally that we're trying to build over the last 4 days or so and warns that the Fed may have to cut rates sooner than later and says that's actually bad news for stocks. Let's bring in Andres Garcia Amaya. He's the CEO of Zoe Financial. Andres, people have been chasing tech stocks and Bitcoin and all the rest of it, and this idea that, maybe a rate cut is a good thing, a liquidity pivot. What would you say to that?
If we look at the last couple times the Fed lower interest rates, stocks didn't do well during that period. Why? Because usually the Fed's kind of catching up to what's happening in the economy. They're on the growth side or the inflation side. So if the Fed were to lower interest rates to try to help financial stability, I don't think that's good for stocks. If the Fed were to lower interest rates because they beat inflation, maybe that would be a different story. But with inflation at 6%, I don't think that's going to be the case this year.
Yeah, well said. It's also, and you're emphasizing that we're so obsessed with the failure of SVB today, obviously. But to you, in some ways, that was a macro event. That was a markets event. And the scars, for instance, of what happened in the 2-year, that 3-day plunge, you think that's pretty telling, no?
Absolutely. I think the bond market reacted a lot more stronger than stocks this time around, basically telling us the Fed's going to have to blink, right? If they went from solely focused on price stability to now financial stability, the bond market tends to think now that they're going to have to focus more on that financial stability. Stock market didn't react as harsh, right? I think the stock market is trying to see if this event on the regional banks becomes just kind of a history lesson rather than something much bigger.
You make the argument, we've heard from other voices here in the same vein. Paul McCulley is now very much in this camp. Why do you think that no Fed officials themselves, if you listen to them, you'd sort of think it was a very different economic reality. Why?
I am so glad I'm not in those seats right now, because everyone's crystal ball just got a little bit hazier, right? Once the financial stability concerns become larger, we learned how quickly the world could change in 3 weeks, right? So I think they have a really tough job of basically having that price stability goal not going away. Because, imagine if they say, okay, forget inflation, even if it stays at 6%, that's not good either. Right. So I think they're now stuck in a hard place with no easy decisions.
They could get up there and say, hey, everybody, inflation's already receded by 1/3. It's falling almost as quickly as it rose, and we expect it to keep turning over. Look at the home price data this morning. They could choose to start building that narrative, say, people, we're not doing this in spite of inflation. We're doing it because inflation appears to be heading way back down. But I don't know why they just don't seem to want to talk about that.
I think the issue is that if they do that and they're wrong, right? Let's say they start lowering interest rates and core CPI stays elevated. Okay, what are they going to go back to hiking interest rates in an environment where a recession is a danger, right? So I think they're just stuck between not really good options left on the table when it comes to price stability.
Yeah, it's just odd because people in the markets go, we see the accident forming. We think the Fed probably knows it, but feels like, they can't really communicate. They'll err on the side of causing the accident. It's just odd. So what would you do with markets or investments or strategy at this point, let's say for the next 6 to 12 months?
Yeah, and that's the key, right? Important to caveat here. If you're investing for retirement 10 years out, I think you don't make any drastic changes, right, to your allocation. If you're looking at the 6-12-month horizon, I think that we're just going to expect a lot more price instability on the markets, not just on inflation. And what that basically means is stocks basically stuck in purgatory. I don't know if we're going to break through October lows, but I don't see any environment right now, like the ingredients for a bull market to emerge.
What then would you do? So T-bill and chill was the refrain until it kind of blew up the economy. So what would you do with, for instance, those still high yields on anything from 6 to 1, maybe you could call it 2 years? Where do you think
we definitely have seen the importance of cash management becoming part of asset allocation. And what that basically means is a lot of people didn't realize that they were making 1% or 0.5% on their cash. So that becomes a key part, right? Talk to your financial advisor. A lot of people find surprising that they can make 4 or 5% on their cash right now. So a lot of that's going to happen, which, by the way, is the danger with the regional banks, right? Mm-hmm. Deposits were so low. That's where the money started to come out, is because there's better options out there in places like money markets.
But you would endorse moving it to those higher yielding areas?
Let's put it this way. It depends on your current situation, but some people didn't even realize that was an option, right? I know we encounter a lot of times people that are still sitting on checking or savings account yielding 0.5% or 1%, right? So there's still a lot to be done there without having to shift everything away from stocks or bonds to generate better returns.
All right, Andres, great to see you today. Appreciate the warning. Andres Garcia Amaya.